Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. Chicago soybeans. It's been a few weeks since I looked at this daily chart as I was writing and publishing the annual reviews, but I have to say in that time the market is behaving itself extraordinarily well in exploiting the patterns previously highlighted and moving towards the relevant targets for such patterns. Prices continue to move up and away from the previously highlighted congestion zone made up of the lesser Fibonacci lines at 1400, 1389 and 1378. I saw the area of the lesser Fibonacci levels as an ammunition gathering exercise for the move higher, plus we have the results of a larger process in operation, and that's the July to late October descending triangle, which I've highlighted in dark blue on my daily chart. The upper trend line used for the now defunct mid-August to date downtrend backed up a little higher up for most of the time by what was at the time a paralleling and declining medium moving average, currently at 1445. Meanwhile, below those same levels of 1400, 1389 and 1378, they acted as the base of this triangle. At the end of November and going into December, prices punched up and over the 50% Fibonacci line of the December 2020 to February 2022 move at 1451, whilst utilizing the base of the medium moving average to do it. The potentials in the upside from the descending triangle pattern, as I said 10 weeks ago, and I quote, so taking all that into account, a primary target X would be in the 1545 area, and a secondary and much harder to reach target X1 would be in the 1605 area. End of quote. I also added something at the time which has turned out to be very prescient, and I quote, so what have we topside that might get in the way? Well, to be honest, not much. Which is why I'm a little surprised and concerned that prices have not moved higher than they have. You see, we have highs in September at 1493 and 1508, but the next clear resistance topside is in the band between 1521 to 1534, containing the flatlining long moving average. The long moving average is now actually dipping low and is currently at 1500. And the 50% Fibonacci line for 2022 at 1532, and that's the end of the quote. Well, prices eased higher, breaking over a number of capping factors, notably the April 2022 to date downtrend, which has since been retired. Secondly, the long moving average, initially breaking over that in late December and then again more forcefully last week. Thirdly, utilizing a new pattern, a bull channel from mid-November, currently 1496 to 1543, and highlighted in purple on my daily chart. In fourth place, there was a golden cross, a lagging indicator of the rising short medium moving average, currently at 1472, moving up over the slowly rising medium moving average. In fifth place, and at the time of reading, breached but not broken, so is realistically the next resistance we have overhead, is the 50% Fibonacci line of February to July 2022 move at 1532. Then we come to the most recent action, and that has been a test this week of the 50% Fibonacci line and the upper bull channel line. So far, both have held, but it is interesting to note that yesterday's high of 1544 and 3/4 is only a quarter under the optimal target X of 1545. I could say it reached the area, which would be fair, but I'm interested in the action as well, as it was a daily key reversal down yesterday. Now, normally after grazing a target that way, I'd pay special attention to that pattern that knocked it lower, but at this time I'm cautious about yesterday's action being a turn lower. You see, the action still looks somewhat lacking in strength on the downside, though I would still give the action over the next few days some closer attention. I'm just mindful that the bull channel just looks a lot stronger than this one-day pattern, at least for now. That being said, target X, X1, the secondary target topside, is still a long way away. Chicago soybean meal. We've had here, and heavier still for months now, different patterns, not so much melding in with each other, but rather crashing in and out of each other. The main pattern continues to be the May to date seemingly broken, then repaired, ascending, expanding wedge pattern, something I pointed out many months ago. And this has developed, and it's currently 414 even to up off the top of my daily chart so far that it really doesn't matter now. It is not a perfect pattern by any means. To assist in seeing this pattern, I've highlighted it in dark blue. It's worth noting that the lower trend line is also the neckline of the huge December 2021 to June 2022 Head and Shoulders continuation pattern. This second earlier pattern had been the signature pattern here since last year, and you can see how it still resonates even as recently as late November last year. The move higher punched through some interesting levels and filled a significant gap. Prices went up through the early and late August highs, the 2 September highs of 444.80 and 443.80, filling in the changeover gap from August last year until prices finally peaked in early December 2022. The combination of the 2021 high at 471.40 and the neckline, which I have highlighted in bright red, of the February to April 2022 Head and Shoulders top, currently at 473.70. The market since staggered lower, but found support from the September 2022 highs again, finishing with a thin, possible triple top formed over Christmas, and a subsequent move lower over the turn into the new year. Prices made new highs, pushing up through the 2021 high again at 471.40, and even last week over the June 2014 high at 479.30. However, then the changeover gap hit again, and we have a new gap this week between 475.20 and 466.80. Prices have since tried to fill in the gap, but yesterday's combined key reversal down and bearish Harami have at least temporarily put a stop to that. This has left us with the question of what may be likely patterns in the weeks ahead. Last time, there was a definite tendency to look at the late November 2022 to-date action as a possible bullish halfway hesitation. The changeover gap has dented that idea, though it is for the moment still out there. What this gap has done is add the concept of the same action, instead of being a bullish halfway hesitation, maybe becoming a possible lopsided double top. Now, neither idea is ideal. Indeed, they are far from any form of ideal. But that is all that is showing right now. Needless to say, it is too early to even contemplate targets for either of these potential ideas. Chicago soybean oil. The key recent features here have been feature 1, the lower time, currently 60.21 of the December 2021 to June 2022 bullish shift visual, which I have highlighted in dark blue. This lower time, along with feature 2, the April 2020 today uptrend, currently at 60.81, and which I have highlighted in bright red, halted the decline in mid-December last year and started the subsequent move higher. This move higher was not accomplished just with these two, no. They had help, as just below them is a whole series of other supportive features, including the 2011 high at 61 even, and supports at 59.44, 58.82 to 58.16, which inside has the August 2011 high at 58.59, plus the December 2012 high at 57.64. This all caused the market to revert back up, and in the process form an interesting small ascending wedge pattern over December last year. I've highlighted this pattern in bright green. In late December, the market broke down through the base of the pattern, thus initiating a primary target in the 64.08 zone and a secondary much harder to reach target X1 in the 58.82 zone. The market easily reached the primary target, but the harder to reach secondary target is still out of reach. Since the break low, we have seen the market clinging so much washing to a washing line. And that's to the lesser Fibonacci line at 63.73, that is just under the 50% Fibonacci line of the January 2021 to April 22 move at 64.09. The question as to why the market has not taken the opportunity to drop lower, well, that's easily answered. The lower time and the uptrend have advanced higher since early December, and they are now mingling with the 2011 high at 61 even. In mid-February, these three will start separating out and thus reducing their combined efficacy. And if we are still around here at that time, as in the price is still around here at that time, then perhaps it may be the time to see a test lower. In the meantime, we have three declining bearish moving averages capping the market. The medium moving average currently at 66.68, the short medium moving average currently at 67.04, and the long moving average currently 69.06. I will be interested to see if the market fancies its chances more with those resistances than with the supports below.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.